All right, let's get right into it. You know, sometimes there's a story unfolding in the financial world that isn't really making the headlines, but it's one that's going to affect pretty much all of us. And this is one of those stories. It's about a ticking clock, a massive bill that's about to come due, and, well, a $7 trillion question that, for some reason, almost nobody seems to be talking about.
Yeah, this question, it really just cuts right to the heart of the whole thing, doesn't it? I mean, for more than 10 years, the entire global economy was basically running on super cheap money. It was like an open bar. But now, the party's over, the lights are on, and the price of borrowing has just shot through the roof. So the real question is, what happens when all these companies suddenly can't afford to pay the new price?
And that is the number $7 trillion. I mean, just let that sink in for a second. That is the staggering amount of high-yield bonds and leveraged loans, we're talking risky stuff, that has to be either paid back or refinanced by the end of next year. It's not just a wall of debt, it's a tidal wave, and corporations are sailing right into it.
So that's what we're going to do in this explainer. We're going to pull back the curtain. First up, we'll dig into how on earth we even got here. Then we'll look at the real-world impact and try to figure out why this huge story seems to be hiding in plain sight. All right, so to really get our heads around this debt wall that we're staring down, we've got to go back in time a bit. Because look, this problem didn't just pop up out of nowhere. Nope, it was built bit by bit over more than a decade of some pretty unusual economic policy. So think back to right after the 2008 financial crisis. The whole system was on the brink. So what did central banks do? They slammed interest rates down to basically zero. They wanted to get the economy moving again. This whole era, which people call ZIRP, the zero interest rate policy, it lasted for over a decade. It created this world where borrowing money was just ridiculously cheap, and you better believe companies took full advantage. But here's the kicker. What did they actually do with all that cheap cash? Did they build new factories, invent the next big thing, invest in long-term growth? For the most part, no. Instead, a ton of it was used to juice up stock prices by buying back their own shares, paying out dividends to shareholders, or just buying other companies. It was all financial engineering, not really building anything new. Okay, and this is where it all starts to click. This is kind of the aha moment. It's where the simple and honestly kind of brutal math of this whole situation becomes crystal clear. It really just comes down to numbers. I mean, the world has just completely flipped for anyone who needs to borrow money. A few years back, a company could get a loan from maybe 2 or 3%. Easy. But now, when that same loan comes due, they're staring down the barrel of refinancing at 6, 7, maybe even 8%. It's a whole new ballgame. So let's just break this down with a quick example. Let's say a company has $1 billion in debt. Back in the day, at 2.5%, they were paying $25 million a year in interest. Manageable, right? Well, now they have to refinance that same $1 billion, but at 6.5%. Suddenly, their annual interest payment jumps to $65 million. That is an extra $40 million a year they have to find. So where does that money come from? Well, it comes from cutting back, right? It means they're not investing in new projects. It means hiring freezes or, let's be honest, probably layoffs. That $40 million hole gets filled by slowing everything down. And that is exactly how a problem that starts on a corporate balance sheet turns into a real-world problem for the rest of us. And look, this isn't some abstract problem for 10 years down the road. Not at all. The cracks in this wall of debt, they are already starting to show. The evidence is piling up that the pressure is building as we speak. If you look at the riskiest companies out there, the ones with what they call CCC or junk ratings, the picture is, well, it's pretty scary. A jaw-dropping 81% of their debt that's coming due hasn't been refinanced. They're basically trapped. They can't get new loans to pay off their old ones. And that, my friends, is the first stop on the train to default. 340%. That number is a massive red flag. That's the year-over-year jump in something called distressed debt exchanges. And what that is, it's basically a last-ditch Hail Mary pass for a company that's on the edge of bankruptcy. They try to cut a deal with their lenders to stay alive. Seeing that number skyrocket, that is a huge sign of extreme stress in the system. And hey, it's not just analysts or people like me pointing this out. The official bodies are sounding the alarm too. Just recently, the Bank of England put out a warning about these exact vulnerabilities.
And they even admitted that their usual toolbox might not be enough to handle what's coming. When a major central bank says something like that, you should probably listen up. You know, this whole situation has created what people are calling zombie companies, and it's a perfect name for them. These are businesses that don't even make enough money to pay the interest on their loans. The only way they stay alive is by taking on more and more debt to pay off the old debt. It's the classic extend and pretend game. And if that sounds familiar, it should. It's the exact same playbook we saw right before the 2008 crash.
And if you look at the leverage ratios, which is just a fancy way of saying how much debt a company has compared to how much it earns, well, they are deep in the red zone. The general rule of thumb is that anything over 4 times your earnings is getting risky. Well, the high-yield junk-rated companies, they're sitting at nearly double that. They're just way too leveraged for a world where interest rates are this high. Okay, so what does this all add up to? When you take a step back and look at the whole picture, you start to see the huge systemic risks and the really impossible choices that policymakers are facing. There are just no good, easy answers here.
But here's a really interesting question, right? If things are so precarious, why hasn't everything just blown up yet? I mean, on the surface, things seem kind of okay. So why aren't we seeing this huge wave of bankruptcies already?
Well, the short answer is that these companies are basically living on borrowed time. Here's the playbook. First, you burn through all your cash reserves. When that's gone, you start selling off the good parts of your business, your most productive assets. But these are just temporary patches. It's a strategy that only buys you maybe 12 to 18 months, and then you run out of road.
Which, of course, leads to the most critical question in all of this. When the music finally stops and these companies can't pretend anymore, who gets left holding the bag? Who ultimately pays the price for all this worthless debt? Because the risk, it's not locked away on Wall Street. Oh no. It's sitting in the pension funds that are supposed to be managing your retirement. It's on the books of insurance companies. And it's held by millions of regular investors, people who were told to put their money in high-yield bond funds to get a better return. This is absolutely a Main Street problem. And all of this puts the central banks in an absolutely impossible position. It's a classic catch-22. Option A, they cut interest rates to save all these indebted companies, but that probably sends inflation right back through the roof. Option B, they keep rates high to keep fighting inflation, but in doing so, they basically pull the trigger on a huge wave of corporate defaults and maybe even another financial crisis. What do?
So here's the bottom line, the most crucial point to take away from all this. This debt maturity wall, it isn't a theory. It's not a prediction. It is a simple, unavoidable calendar fact. We know exactly when these trillions of dollars in loans are coming due. The only question now is how bad the fallout is going to be. And that leaves us with one last kind of troubling thought. We've all seen this movie before, right? When huge financial bets go sideways, somebody somewhere starts talking about a bailout. So the real $7 trillion question is this. After a decade of companies making some really questionable decisions with cheap money, who's going to be expected to pick up the tab this time around?